Hello, I'm Diane Morgan. If you know who I am, you know who I am. If you don't, who cares? I'm here to explain Italian Time, a holiday phenomenon where Italians throw away their clocks and gather for eternity with San Pellegrino. I've been at this party so long that I've eaten 5 courses, hugged someone's grandma twice, and been offered a job in the family restaurant. So this holiday season, make sure to bring enough San Pellegrino to last you through the meal, the after meal, and the entire goodbye ritual. San Pellegrino, holiday on Italian Time.
When evaluating potential hires for your small business, it's essential you look beyond resumes. Sure, a candidate may appear impressive on paper, but understanding the person is crucial. LinkedIn, the world's largest professional network, provides a complete view of your candidate's skills, experiences, and interests. With LinkedIn's up-to-date data, you can be confident that you really know who you're hiring. Post your free job at linkedin.com/achieve. That's linkedin.com/achieve. Terms and conditions apply.
Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started.
Welcome to my last episode on the Value Investing series. On today, I want to start wrapping up everything that we've learned because I know that I included a lot of topics in the entire series because, as you saw, value investing is going to be very meticulous. But also, I hope that you noticed, if you were listening to all of my episodes, that we are not redesigning the wheel or having new strategies that are going to be completely different from all of the valuation things that I taught you in my finance episodes, or we're not doing new analysis other than the one that I was mentioning in my business analysis episodes. Here, we're just trying to be more focused and we're going to have specific things in mind in order to maximize our opportunities of finding mispriced securities. So, in today's episode, what I wanted to do was create like a checklist so you know exactly which steps you should take now that you already know how to do everything. But I want to emphasize here that I'm creating this checklist not because I found it in any textbook or not because it's validated by my professor or Warren Buffett. This is more of a personal checklist. So I don't want you to believe in any way that this is the only process. If after listening to all my episodes you found your own method, it's okay. I'm just suggesting my method. And why a checklist? Well, I'm going to go back to one of my initial episodes as well. We're filled with biases. So what I like to do personally is have a checklist that reminds me again that this is a process. This is not just some gut feeling or some company that I really like and I want to get into. This should be a checklist process. And so for the checklist, I'm going to have 6 total steps and I'm going to go through each one of them, but briefly because I explained already how to do all of them throughout my other episodes. So the first step that I didn't initially explain, but I talked about it in my previous finance classes, is going to be create a screen. And creating a screen is going to be something that every person in finance usually does. Screens are like filters. And with this initial filter, you're going to take or select some of the stocks from this vast universe of stocks down to a manageable list of potential candidates that will meet your initial quantitative criteria for value. So, how do you do some of the screens? This will only be my suggestion, but you can use quantitative filters. So you can download this databases or screening tools even online to look for companies that have value investing characteristics, such as a low PE ratio, because this is going to mean that the company right now is trading cheap. A low price to book ratio, it might be the same, but you can add it also. High dividend yield, because this is going to ensure that the company is earning excess returns, and usually companies that give out dividends have excess returns repeatedly. Strong cash flow generation, this is going to be my 4th factor. You can also maybe look for low enterprise value to EBITDA, or you can add any other additional thing that you might consider. If you're putting these filters, it's going to kind of narrow down into the best stocks that you can find. So if you're looking at stocks that meet this 5 criteria or the criteria that you determine in order to see which stocks might be good, but they're trading cheap right now, it's going to be your initial assessment. And let's say from those, you're going to pick the best 5 or the best 10. Okay? After you have this one, we're going to move on to step number 2. Step number 2 is going to be understanding the business and basically identifying if you can find a moat. So I like to do first the qualitative deep dive over the quantitative one, but you could do it again differently. You don't have to do the things my way. You could start with the numbers, but I think that going beyond the numbers in order to understand the company's fundamental business, its competitive landscape, and the sustainability of this profits is going to be the important part. So for this, you can just do a thorough business analysis. You can, for example, look at the business model and thoroughly understand how the company makes money, its products, services, its target markets, its recent growth. You have to understand all of this. Then you should second also look into the moats that this company may have. So remember, I was telling you about the 5 moats according to Morningstar. There are going to be intangible assets, switching costs, network effects, cost advantage, and skill advantage. You can re-listen to my episode if you still have some of the questions around it. And lastly, I would also look at industry dynamics. So in this one, you can also go back again to all of the industry analysis that I explained in previous episodes, but you should understand the industry structure, the growth prospects, the competitive intensity. For example, you should understand if it's going to be a volatile industry like oil and gas, or if it's going to be more stable. All of these things are things that you should consider. And from those, again, I would keep selecting some to do the rest of the analysis. So let's say if I started with 5, I'm going to select those that I liked and I'll take the top 3. If I started with 10, I'll select the top 5, etc., etc. You decide how much analysis you want to do, but spoiler, this will take you a long time. Now, after you finished already doing the qualitative analysis, step 3 would be doing the math, so financial analysis. Here, we're going to conduct all of the rigorous quantitative analysis that I was explaining in my previous episodes in order to understand the company's financial health, performance drivers, and intrinsic value. So, of course, we're going to do financial statement analysis. This is something that I explained in my episodes about business analysis. We're also going to look into the key financial drivers. So I hope you already have them ingrained in your brain. They're going to be ROIC and growth. We are going to be looking into this too. Then we're going to do a very thorough forecast. And remember, you're going to do it based on the inside view that you have of the business, of the things that you can identify, but also on the outside view, which is the base rates, the mean reversion, the industry trends, and competitors. So you're going to do this thorough forecast. And then you're going to decide how you're going to do your valuation. You can do it with DCFs and free cash flow of the firm, for example, and discounting with the WACC. And the last part over here would be doing your reverse DCF to understand market expectations. So, of course, this third step will be the most thorough one because you have to do 5 different things in this step. You have to do financial statement analysis, key financial drivers, forecasting, valuation, and reverse DCF. So, once you have that, you can already move on into step number 4, which is going to be like the risk assessment and your thesis development. So over here, you're just basically going to put everything that you identified and you'll start seeing which company is going to be more risky. You should look at the fundamental risks to assess risks that may be related to maybe tech disruption or regulatory changes, competitive threats, supply chain, management execution, everything that you want. Think of every possible risk. And for this, I've constantly used Gen AI tools such as ChatGPT or Gemini because usually Gen AI tools are better at identifying risks than I am. But so I want you to look at all of the fundamental and financial risks that this company might face. And then we're going to think of how we can calculate our margin of safety. And the margin of safety is going to be the difference between your intrinsic value estimate and the current market price. Again, you want this one to be as big as possible.
Here's to quitting. Quitting the couch for a quick run. Quitting the snooze button for a morning workout. Quitting giving up after 2 weeks. You see, staying committed to your fitness goals isn't easy. But with Apple Watch, you don't have to do it alone. Because Apple Watch gives you real-time motivation, plus advanced metrics that track all your workouts, so you can stick to your New Year's fitness resolutions. And once and for all, quit quitting with Apple Watch. iPhone 11 or later required.
Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
Because it will be how fat or how thick is your cushion against unforeseen events or your own analytical errors. And now that you already identified the risks, then fifth step would be what I was talking in my previous episode, position sizing. Here we're going to determine how much capital we're going to allocate in the mispriced security in order to maximize the long-term wealth while managing overall portfolio risk. Here, you should remember maybe to do the scorecard if you want, and you should allocate larger positions to the biggest conviction ideas that you have based on your scorecard. So those with margin of safety, stronger modes, most asymmetric risk-reward profiles, for example. Then you should look at the Cali criterion principles and understand that position size should be related to the expected return and probability of success or loss. And you should consider this fractional Cali for practical application. And then you should consider if you want to concentrate or differentiate and how you're going to keep rebalancing your portfolio, because this is something that I didn't mention before, but you have to be prepared to adjust position sizes as your thesis evolves. Maybe evaluation will change, a new opportunity will emerge, so this might involve cutting out some winners that become overvalued and increasing maybe some of the losers that are now cheap. So your margin of safety expands. The last and sixth step is going to be that you should continuously monitor and make decisions that will optimize it. Because it's not that you just found a stock and that's it. I don't want you to fall into the biases that I mentioned in my first thing. So I don't want you to now think that just because you did all of this analysis, you're right. You may not be. You have to regularly review your investments, stay updated on company and industry developments, and make all of these rational decisions, even when your emotions are high. So I think you should first monitor all of the fundamentals. You already have this model, so you can just plug in updated numbers, track the key financial drivers, competitive landscape, management actions, and see how your model is behaving according to new data. Maybe you might need to reevaluate your thesis because it might become a wrong thesis if something changes in the company, or you might think you're still good and you should keep your position. You have to also focus on the process, so prioritize this repeatable investment process over short-term outcomes. And lastly, be aware of the biases. Maybe you should re-listen to that bias episode again because it's going to be very important. So avoid overconfidence, loss aversion, confirmation bias, anchoring, herd behavior, or just looking into the short term. All of these things might lead you to act emotionally and not rationally on your investments. But that's it. There's no extra magic here. If you already followed these 6 steps, you'll become a value investor. And even though we still don't know if you're right or wrong, at least you did a process that is optimizing for the best results, and probabilistically, you'll be correct more than any other type of investor. So even though you might lose, you were putting all of the odds in your favor. I hope you enjoyed all of this series of episodes around value investing. Let me know in the comments if you did, if you want me to keep doing more investment episodes, and also if you're sharing it with your friends so they can also learn about investment and you can talk about the stocks that you both like together. And we can keep spreading knowledge from my MBA to the rest of the world for free. Also, give me a review if you liked it and subscribe, because in my next episodes, I'm going to start a completely new series, but it's going to be kind of related to moats because we're going to talk about technology strategy and how we can combine intellectual property to make a company strong against every possible competitor. I hope to see you next week and keep learning more about MBA things.